What is fueling this movement, and how do investors make sense of it all as interest rates continue to move? BlackRock's Global Chief Investment Officer of Fixed Income joins me now, Rick Rieder. It is great to see you, Rick.
Thanks, Brad.
Thank you so much for joining us. And I got to say, great call, because you joined us more than a month ago, and you said the Federal Reserve is not going to be able to raise interest rates as much as people think, right, and that you want to be buying the front end. All of that has come true. Right. The Fed has signaled now that it's just going to watch the data. 3 rate hikes is not cooked into the books. We are expecting a rate hike, though, next week. What are the chances?
Oh, I think it's high. I mean, unless for whatever reason markets really come off for the next couple of days, I think the Fed would like to go. I think they'd like to go in December, but then I think it's a whole new ball game. Then I think they're going to say we're data centric from here, and quite frankly, I think it's going to be symmetric from here. I mean, I don't think they're going to ease, but I don't think they're going to have to go anymore. Maybe they get another hike in next year. But listen, the data is slowing, but more than anything else, inflation is not increasing. In fact, it's coming off a bit. Listen, people say, my God, there's so many jobs, we're through full employment. What's the difference? If you're not creating inflation, put more people to work, and so I don't think you need to go much further.
So what do you make of these market moves? Is the market just trying to digest a new era, an era of, growth slowing down? What's going on with rates and stocks?
Yeah, so I think a lot of it is, we've been in some pretty significant growth, and now it's coming off. And one of the things people have to worry about is the global growth outside the U.S. It is slowing significantly, and so we live in a global economic environment. So that is one. The uncertainty around trade and what it means for inflation, that is significant, and that's two. And then three, you have the dynamic of all of the other risks in the world, all the other risks in geopolitics, et cetera, and that's creating some risk in the system. I think the Fed. I think we're going to lift one of the very big ones when we see that the Fed is not going to be that aggressive going forward. Listen, I think as you get into the new year, people are going to look at, gosh, I could start to put some money to work again. The economy's actually going to be fine, and then I think you'll stabilize.
But the Federal Reserve may back off of raising rates too many times because the economy is slowing. Mm-hmm. So how much of a worry is that to you that we saw 4.2% economic growth in the second quarter, 3.5% economic growth in the third quarter, and what are we talking about for the fourth quarter? Alan Greenspan this week told me, it's probably going to be 2.5%. Does it worry you that people are talking about a recession in 2020?
Well, it doesn't worry. I think they're wrong. I think you're going to grow at low 2s next year, which when you take the demographic we're operating in today, it's not like the 80s and 90s where this booming demographic and then you could grow at much higher rates. If we grow in the low 2s, low to mid 2s next year, which is I think where we're going, it's fine. By the way, you look at retail sales numbers that come out pretty good. Yeah. Manufacturing data pretty good. Unemployment, we're going to hit. I think we're going to hit 3%. And by the way, I don't think we're going to hit it and then it's going to start to move up. It's going to be, I don't think there's enough workers for the jobs in this country today. It's pretty powerful stuff. So people say we're going to be in a recession. There's so many influences that suggest that's not right for at least for 19 and maybe into 20.
So how do you invest right now? The last time you were with me, you talked about the front end, putting money into the 2-year, the 3-year. Is that still where you want to be?
Well, definitely keep money in the 2 and 3 year. It carries, it's good income. It's
You're
still
getting
close
3%.
In a world where there's a lot of uncertainty, equity volatility is high, 3, and I'll worry about it in a few months, doesn't hurt. But for the first time in a while, now you have a Fed that's not on autopilot. Can I buy some longer-term interest rates, particularly if I own equities or I own other assets? 10-year interest rates in and around 3% now with a Fed that's not moving, with inflation. I think inflation is moving down. You're going to see headline inflation. Look at what's happening to oil prices and gasoline. Inflation's moving down. We're going to see inflation at probably close to 1.5%, down from 2 or a little over 2. Boy, if I own longer-term interest rates, I'm not that worried about them anymore. So for the first time, I like shifting a bit more into longer-term interest rates. Municipals work, longer-term munis work pretty well. You don't have to just sit in the 2-year anymore. Mm-hmm. I think it's different environment. And by the way, I still think, given valuations now in equities, I still think having some exposure to equities makes sense. And I think the last thing I would say is, now that because you could buy other interest rates, they actually help you as a hedge against your equity holdings. That's a really big deal because you didn't have that in 18. You didn't have that in 17. It's pretty powerful.
Is the stock market overreacting to all this uncertainty? 800 points down, 600 points down. The wild swings have been.
I think the volatility. The one thing that people, it's hard to see underneath the surface. The liquidity in the world, when the Fed drains liquidity and the ECB ends their QE program and the Treasury issues so much debt, you drain liquidity from the system. What happens is volatility goes up, and then you have players that have to get out of assets. you're seeing a big deal relative to that today. It's one of those things that happens underneath the surface that professionally you see liquidity being drained and people have to sell assets, and you see outflows in terms of financial assets. And that's a big deal. So I think the markets are overreacting, like you say, but it's because the liquidity is lower.
Rick, it's good to see you.
Maria.
Thank you so much.
Yeah,
Rick Rieder.